Hi and welcome everyone. My name is Mikael Kosker Rasmussen and I'm working as an equity analyst here at ABG, where I cover Danish IT and tech companies. And today I have the pleasure of welcoming Christian Sendevad, the CEO of Penneo. And actually, Penneo has today reported its Q1 earnings. And I think, at the first glance, probably not so good. But when you look at the numbers, I think they're pretty decent. But I think Christian will talk obviously about the business, Penneo, the case, but also I think he'll mention something about the Q1 results. The drill, Christian. It's 20 minutes of presentation, then followed by 5 minutes of Q&A. So if you're ready, then please go ahead.
Thank you very much. And thank you for the opportunity and welcome to all of you. I will, if you take the next slide, I will start up with a very short introduction to Penneo and our business and our business model. And then later on, we'll go to our financials. And if you take the next slide, then what we can see here are some facts about Penneo. We are headquartered here in Copenhagen, where I am today. And we have more than 3,000 customers in Denmark, Norway, Sweden, and Belgium. We have a great team of 110 people. Almost half of the employees are working within product and engineering. In April 22, we went on Nasdaq Copenhagen main market. Prior to that, we were listed on First North. And one of our core strategic industries is auditing and accounting companies. And therefore, we have a fun fact here of our penetration is that in Denmark, 81% of all annual report filed to the Danish Business Authority in 2022 were signed using Penneo. And if you are from Sweden and Norway or Belgium, you might have experienced the same, that you have signed the annual report using Penneo. If we take the next slide, that's a little bit about our journey. And we were founded in 2014, and we have been since then on a remarkable journey, founded by some visionaries, entrepreneurs who had this idea of killing the pen and replacing that with a digital alternative, simply to eliminate inefficiency that we have with all the manual processes around that. They co-created the solution and the support of workflows with auditing accounting. So that what came from the very beginning, and that was quite successful. And based on that solution, then we expanded into Norway and Sweden, and then later to Belgium. And going forward, you can say we have an European expansion as a vision. We also added on other solution. One is KYC, knowing your customer solution. That's part of the anti-money laundering regulation that you have to live up to that regulation. You need to have a KYC or know your customer solution for the onboarding of it. Today, in 2024, we have a platform with the solution and with a lot of integration into third parties. And then we are on a mission to become the preferred digital signing and KYC workflow platform for the anti-money laundering regulated business-to-business company in Europe. If you take the next slide, then we have, as I said, a strategic focus on auditing accounting. And core of their business is to serve, you can say, if they were a smaller auditing company, then maybe hundreds of clients. And if it's a large one, then we talk about thousands of clients that they have. And what do they help with? That they're doing the accounting and also the annual report. So an auditor can handle maybe more than 100 clients. And they are very busy right now because all their work often is done here in the first half and especially here in Q2. And as part of that, you say they need to become more and more lean in order to deliver their services because there is an increased competition. This slide shows a survey that came out last year, and they concluded that for this industry auditing accounting, the whole digitalization, increased regulation, and also employee retention is creating a vicious cycle for their industry. So in most companies, digitalization and the whole automation is translated into efficiency and productivity gains that is freeing up employee resources. So in the whole basic of what they're doing, they really have been better and better of digitalizing. But this is not enough to outweigh the growing burden of quality assurance, control, and compliance dues to increase the regulatory demands. And one of these regulatory demands is clearly to live up to the anti-money laundering regulation. And part of that is to perform, a proper know your customer. And the regulation is just getting more and more. And meanwhile, where they have these enhanced compliance requirements, A&A in general are struggling to attract and retain employees, including accounting, and adding these extra pressure on existing employees that are creating a stressful work environment. So that's really part of that issue. And then on top of that, the whole regulatory complexity is creating more demand for specialized consultancy service. And the ability to provide this is becoming a key differentiator. So not only the basis of the standard auditing and accounting, but also do more services to be able to do advice on these regulatory things. And this increased workload and complexity of tasks is driving a change in general in the industry, including consolidation, price pressure, and changes to the service portfolio. So what had been seen here, now it was a Danish one, is exactly the same in Sweden, exactly the same in Norway, and also exactly the same in Belgium and other countries in Europe. Now we also talk with German customers, and when we show this, they say yes. And when we translate that, if you go to the next slide, translate that into recognized challenges. So when we are in a direct dialogue with our customers and potential customers, then they really also say, going into their daily work, time spent on tasks that could be automated. That's really one of the challenges. I think there are many tasks that can still be automated. So, for example, manual analog handling of signing or case file or document storage, digital tools that need to be integrated. So they might have a point solution, but it is not integrated. Employees simply spending too much time manually on onboarding and monitor clients in order to get them on board before they can serve them. And then this increased compliance demand that are hard to manage. It's difficult simply to keep up with legislation that are coming and then secure regulatory compliance. It's also difficult to keep track of all their clients. If you have 100 as an auditor, you need to be on top of their risk level and their onboarding status to live up to the regulation. Then it's also hard to deliver a satisfying client experience, which is becoming usually also a competitive factor, that the client needs to have a good experience. And it's difficult and time-consuming with all the communication forth and back with the client, when requesting, for example, a document to sign as an annual report. And also, if they're not using the full potential of the whole digitalization or have it outdated or offline or impractical or inefficient handling of document signing. And then it's also hard to deliver a satisfying employee experience. So many different tools are used in the signing process, creating room for human errors and tiny inefficiencies, and also low employee motivation and retention. So what we saw in the survey before on the whole one, that's also exactly what we see on the detail level within our domain. So if you take the next slide, that's in short, what is it that we solve? So we have created and basically co-created over the years together with auditing and accounting. In the whole, when we look at it, the client life cycle, so from a client come on board and until all the service delivered or they are offboarding or they are maintained, we have looked together with auditing and accounting, where is it that we have all the manual processes, and then we have streamlined that from an efficiency point of view, integrated the solution into their system landscape and their standard systems, but on top of that also securing that they are compliant with all the regulations, so they follow every strict that they have to do. And this solution we have co-created with some of the leading auditing and accounting, and then we have sold it to many auditing and accounting companies around these countries. And what we can see is, for example, now we have a lot of success in Belgium that are ramping up fast. And it's basically following the same path that we have seen here in Denmark in the Nordics. We have customers right now that are giving bonus to their employees after they bought the Penneo solution for the adoption. So the quicker they use our solution on all the clients, and basically out of that get both compliant and but also the efficiency, then they get a bonus. And we have even seen job ads where they have highlighted that they are using Penneo, and by that in their company, they have got rid of many of these tedious manual processes. So that ties exactly back to one of the challenges that they have. It's actually a motivating factor for somebody to join if they are on a high level from a digitalization point of view. So we're very proud of that we really can see that in that way. So this is what we are delivering. That was short on what we do. Let's go into the numbers. So what is the business model behind all this and how have that evolved over time? So if you take the next slide, then I will go into some financial highlights. And if you take the next one, this is one of our core slides to show our evolvement, how our business have evolved over the years from when we were founded in 2015. This slide shows, our cohorts, and a cohort is a group of customers from a specific financial year, and that got onboarded, and then the total revenue, and then how that cohort of customers have evolved over the time. And what we can see that every single cohort have grown year by year all the years. We have one cohort this time that have just gone slightly down, but otherwise that's what we have. And if you look at from a general point of view and took all cohorts, then over the first 5 years, on average, a customer that buy our solution are growing 20% year on year over the first 5 years. So that also shows if we can just get up new customers on board, and then they stay and then they grow. That's a very important part, and that's also the reason why we have invested over the last years in getting customers on board and develop them. A very key part of it. If we take the next slide. That shows now this is the latest release we have from today, showing the development during the last 12 months, coming from where did we end Q1 last year with 74.2%, and then where we are today here at 91.3%. So that's a year-on-year growth of 23%. In the last 12 months. But it also shows the division between sign and KYC. So even though the blue is not that high, sign is much bigger than KYC solution from our platform. We also started much earlier. The KYC solution was added. And then it shows how, from a customer point of view, how many of our customers are churning. Right now we have 5%. Over the last many quarters, it have been sometimes it have been 3, it have been 4. Now it is 5, and we have a rule of thumb that as long as it's below 5%, we are happy, because that represents a high level of stickiness. So when they get on board, then they stay on. Then we have the uplift. So for the last 12 months, about 13% uplift, and uplift can come from that you are onboarded to our solution. And then you are simply expanding the usage of it. So you are using, if you are an auditor, then you're using it for more and more of your clients as part of it. It can also come from cross-selling. So if they bought sign and then later on add our KYC features to the platform that they have bought, then that's a cross-sell, and can also, of course, also be vice versa, that you bought KYC and then you add on sign afterwards. So that's 30%. And then that goes to the existing customer portfolio, and then we have a new biz of 16% on a year-on-year, where sign is still, an engine that are driving a lot of the business, but then also KYC from a new business, so ending up on the 91%. And so that is a business. And if you look in all our reports, you can say basically more or less half of it come from uplift if you have growth, and half of it come from new business. Now it has been a little bit less in here with the Q1 report, and then we have other reports where maybe the new business is a little bit lower and then the uplift a little bit higher. But this represents very much our business. If you go to the next slide, then we have a big focus on our European expansion. So we started up in Denmark, then we went into Norway and Sweden. We got a good momentum there, and then we continue in Belgium. And we were lucky or just good to really be there when they started up. You can say be mature enough on digitalization, and then were buying into solutions like ours, and we have seen a lot of growth. So. A large portion of our growth, basically 73% of all new biz come from foreign market, and one of the key drivers that we have seen the last 12 months is Belgium, coming from a very low number and now representing our second largest market. Norway is our largest, Belgium is our second largest, and Sweden is our third. And then we also have others in other countries. but these are our main market. And what we have seen over the years, you can see quarter by quarter, our domestic market, that's Denmark, is still growing, and there's still potential to grow more. And then we're also growing our foreign market. And our focus is to grow more in the foreign market that we have in Denmark. Because of our portfolio in Denmark right now, you can say we've done all the uplift that continues to create a lot of additional business. But we are our focus. So if you look at the foreign market, on a year-on-year, that grew 30%. And if you then take the next slide, that is very much on our, some of our key SaaS metrics. So we measure our business very much, using these SaaS metrics that we follow very closely. One important part is new customers. And here we can see quarter by quarter how many customers we have onboarded. First of all, Q1 and Q3 is normally a low season, and Q2 and Q4 is a high season. And Q4 normally is the highest one, then come Q2, then is Q1 and Q3. That is basically not reflected in these numbers, because when we look at the Q1 numbers, they are very, very high on the number of new customers. Last year, we did a lot of investment in getting even better at getting new customers on board. So our whole capability of creating demands and then get them on board of our solution was a focus area, and we could see that also how that has increased. So Q4, which is a high season, we onboarded 218. That resulted in an increase of 3.8 million in ARR from new business. In Q1 2024 here, we onboarded 206. So that's, our second largest quarter ever in onboarding, and that's even in a low season. So that we were very happy about that. And if we take then the average ARR in the first year for a new customer, then has been, here we have 16.8 thousand. Last quarter was 17, then be 18, and then 16. So that's around these 17 in general. It goes a little bit up and down. If we look at our customer acquisition cost, that's very much depending on the cost. If that's more or less the same, that is very depending on the number of new customers that we get on board, because we simply calculate up against the number of new customers. And under normal circumstances, Q1 and Q3, we have a high, and then Q2 and Q4, we have a lower one. Here in Q1, because of the many new customers we got on board, then we have kept the customer acquisition cost on a low level, meaning that the CAC payback time in months is right now, if the Q1 is 15 months. Our whole business model is based on that when we get new customers on board here with the average of almost 17,000, and our CAC is 21. Because we invoice 12 months upfront, so when we send the first invoice, we have not covered all the costs. But when we, in 12 months after they have signed the first deal, we are sending the second invoice, then basically we have covered all our costs, and then we are positive on that. So that's a very important part of our business model too, that we have that ability. And then we can see how we have improved both in Q4 and in Q1, and that's also a strategy going forward. We really have a focus on new biz. If we look at the net revenue retention, then in Q1, there was a 107. The previous 7 quarters has been between 112 and 114. So that was our normal level. Now here in Q1, it was lower, and that was due to that we had some specific and temporary downgrades on some of our customers, larger customers, and we also had a churn that was larger than normal. So that got a dip down, because normally we are very stable on this level. So it's 107. But that's many of that is temporary. Some of it will go up again. Otherwise, it's been on these 112 for a long time. Our average revenue per account have also increased quarter by quarter, actually from every quarter until Q1, because we had that churn. Then it went a little bit down. Otherwise, it just increased quarter by quarter. And that's simply because our whole cohorts, because they all are increasing year over year, then also the average revenue per account is also increasing in general. So these are the ones that we follow very closely, whether we have some good metrics or not. And also when we look at how much we invest, these are the ones that we look after. If we just take the next slide, because that is showing on the trailing 12 months. Now we have shown, when we now have released the Q1, that has been that from Q2 last year to Q1, and we can also with the trailing 12 months, that's basically the whole financial year last year. That's what we are showing now, and it gives a better picture of what is it on average, because we have the seasonality quarter by quarter. In the trailing 12 months, so they are more precise picture. And here we can see how we have improved in the number of new customers coming in, and also how the customer acquisition cost had gone down, and therefore also the CAC payback time in general, and also how our in total numbers, our new ARR, how we have increased that. So it's a very good trend that we have seen in general. So that was for the SaaS metrics, and then I have a very few slides left. One is our EBITDA. If you take the next slide, that's our EBITDA development, and also the revenue. Now it shows the Q1 numbers. So when we are closing a deal on ARR, then we get also the revenue in, and that follows more or less the ARR closely. And then we have a cost of sales with a gross profit, and then the gross profit margin here has been basically between 80, now 84, and 82, and some others is 86. What we say is, as long as we are above 80, then we are happy, and we have last couple of quarters been even above, more above that. We have a negative EBITDA. We are investing in our business in general. So when we raised capital as part of going on main market, we raised 60 million Danish kroner, and that was because of the SaaS metrics. It really made sense for every new customer we got on board. If you want to say, when we paid once, then over 5 years, then we get the money back 5 times based on what we entered. It was a really good model, so we raised capital to do this. As part of that plan also was that we will do that initially, develop our products, invest in the whole organization to maturity, to systems, to product, to the expansion. But then it should be at our end of our investment cycle, then it should go down, so we are on the path to profitability. So that has been a very important part of it, and that also shows in the numbers, if you are following us, that the EBITDA is it has a seasonality in general, but it is going down. And that I can also show when I now just go to the guidance for the year. If you just take the next slide and the next again. So when we look ahead from the guidance point of view, then we guide that we will reach a level of ARR from 105 to 112 that correspond to 18 to 25% for this year. The outlook is based on currency exchange rates by end of 2023, because it goes a little bit up and down. That has an impact on our ARR, but that's what we expect to do, and that's under these market circumstances that we also have seen in 2023, that we continue in 2024, that the customers are very cost focused, so there is delays compared to the earlier years, but we still, as you can see, maintain that we can get a lot of customers in it. If you just take the next one slide, that's our guidance for the EBITDA, which is also an important part of it. So we have, for the last years, we have been negative. What we see, we also did that with negative 8.7, but we guide to, at end of this year, to be at between positive 5 to 10. So that's really on this path of becoming profitable. And we have announced that already last year, and we continue on every quarter, that we are on a path toward a cash positive position. So we, at the end of 2024, we expect to reach a position where our ARR exceed our cost base, and that will position us to achieve at least a cash neutral status on a yearly basis by 2025. And the whole idea is to get the ARR and the revenue just above the cost, but the cost can then increase if you would like to continue to invest, which is our current plans. So we will come out of this having negative, but it was the plan so far. So we are fully on plan with this. That ends my presentation.
Yeah,
I'm
thank
ready
you,
for
Christian.
questions.
Yeah, I mean, you spent quite a lot of time, but I think we have time for one more question. You already talked about growth, you talked about profitability, but I think when a lot of people hear about digital signatures, they think DocuSign.
Yeah.
How are you going to make sure that you, that you don't get squeezed by DocuSign in the long term? How you make sure that your product offering is better for the customer segments that you're targeting?
Yes. So what we have done over all the years is we have co-created and specialized our solution for specific industries, and auditing and accounting is the strategic industry that we've chosen. And we are supporting all their workflows integrated into their systems, adding on KYC. So we really focus for the whole client life cycle of that. That's the why we do it. So that's specialization. And focusing on an industry, that's how we differentiate ourselves. So we basically do not meet a DocuSign when we go out to our industry. If you just took a standard signature by itself, of course, then we're up against that competition. So if you use it for other things, we are that, but not for our strategic industry.
Okay, perfect. And just one short question there at the end. What do you see as the key risk for Penneo going forward?
Of course, we are depending on that this agenda of digitalization will continue. We fully expect that. Also, the regulation of the KYC and the whole AML, then it's always good to be able to support that they can be compliant. But of course, we are depending on that digital agenda and the general adoption. Now we're entering Germany, and we expect that could be much bigger than Belgium that we have seen recently really perform well. But from a risk point of view, are they really mature enough now or not? We expect it based on our dialogue, but of course that's a risk. Are they as fast as we want them to be?
Yeah. Thank you very much for a great presentation, Christian. I think that's all we have time for today. So have a great day all. Have a great day all.
Thank you so much.